This decision, though, ultimately has to align with your real life expectations and what's going to happen in your life in the future, right? Not your ideal scenario or the market predictions. Interest rate structure is about matching the loan to your plans, not guessing what the rate's going to do or not do in the future. Welcome back. So in this video, we're going to talk about one of the most important structural decisions in a mortgage, okay? And that is whether your interest rate is fixed or adjustable. So it's going to be about fixed rate mortgages versus adjustable rate mortgages, also known as ARMs, okay? So most buyers are usually told, hey, you know what, just get a 30-year mortgage and it's fixed and, that's the best one for you, without ever really understanding why it's the best one for them, okay? So while fixed rate mortgages are really good, they're great options for many people, they are not the only option, and they are not always the most strategic one for everybody, okay? So a fixed rate mortgage means what? Okay, it means that your interest rate stays the same for the entire life of the loan. And that stability is what makes it more appealing, right? Budgeting is more predictable, and your principal and interest payments they never change, they stay consistent, and it removes that uncertainty and allows for long-term planning. And that is why people really like fixed rate mortgages, because of that stability, because of the fixed rate loans that are often, it's a really good fit for buyers who expect to stay in their house for the long term. Value predictability, or simply don't want to think about what the interest rates are going to do in the future. So an adjustable rate mortgage, however, which is an ARM, works a little differently. So ARMs have two phases. And the first phase is their initial fixed period, where the interest rate is locked in for a set number of years. And then the second phase is the adjustment period, okay, where the rate can change based on the market conditions. So I'm going to give you guys an example, okay? So for example, someone says, hey, we have a 5-1 ARM. This means the first number means it's fixed for 5 years, and then the second number is that it adjusts once per year after that, okay? So, and here's another example, 5-5 ARM. 5-5 ARM means it's fixed for the first 5 years, and then it adjusts every 5 years after that. So ARMs are often lower when it comes to interest rate when you compare them to fixed rate loans. So when used intentionally, that lower initial rate can reduce monthly payments and improve cash flow in the early years and save you a lot of money, okay? The problem is, not ARMs. Like I used to hear ARMs like, oh, the rate is going to adjust and freak out about it, right? So the problem isn't that it's an adjustable rate mortgage and it's going to adjust. The problem is when we choose that rate without really understanding our own timeline. So if you plan on, for example, selling your house in a couple of years, okay, so we looked at a 5-1 ARM, that rate is going to stay low for 5 years. So if you're thinking about selling in a couple of years, that 5-1 ARM may be beneficial for you and save you a lot of interest. And also, if you're thinking about refinancing the loan, okay, I'm only going to keep the loan for a couple of years, and I've got 5 years before that rate adjusts, that's going to help me out a lot as well. Or, so this is, or you're going to increase your income significantly in the future. So you know that, hey, right now I can't afford this, but by the time the rate adjusts, I will be making more money, right? That's going to fit your lifestyle a little bit better. So if you are thinking about doing any of these things, maybe an ARM would be a better option for you, and it's a good strategic tool for you to use. So if, on the other hand, you expect to stay in the home long term, and you value certainty above all else, and a fixed rate loan is what is appealing to you, then that may be a better fit. So go with a fixed rate loan, right? So this decision, though, ultimately has to align with your real life expectations and what's going to happen in your life in the future, right? Not your ideal scenario or the market predictions. So interest rate structure is about matching the loan to your plans, not guessing what the rate's going to do or not do in the future. And for all of you realtors out there, Understanding this distinction is really critical. Okay, it allows you to kind of guide your clients into loan structures that support their actual life plans rather than just defaulting and telling them, hey, go get the safest one, a 30-year fixed mortgage, right? So when loan structure and life plans are aligned, transactions are a lot smoother, clients feel more confident, and long-term outcomes improve. And with that being said, I'm going to give you guys a mindset exercise, okay? Once again, always in a quiet space, and really start to think about these things and write them down to learn what your situation is, okay? So let's ask our first question. Yeah, I'm going to give you 3 questions. First one is, how long do I realistically see myself keeping this house or this loan? So it's not your ideal best case scenario, okay? It's the most likely one for you, okay, based on your lifestyle. Number 2, what do I value more right now? Is it certainty or flexibility? Certainty prioritizes predictability. Flexibility prioritizes strategy and planning. And number 3, what changes are most likely in the next 3 to 7 years? Okay. Is it your income? Are you going to be making more money? Is your family growing? Is your career going to be changing? Are you going to be moving out of a state and not living in that house for very long? Or are you going to be staying there for long term? Right? So ask yourself those questions. And number 4, if rates never changed at all, okay, which structure would still feel right for my life? Okay, so this is a really quick exercise, and it's designed to move you out of a reaction and into really intentionally making a choice, okay, a choice that's right for you. And then the right loan is not the one that sounds the safest always. It's the one that fits your actual timeline. So in the next video, we're going to talk about conventional loans and who they're actually best suited for. If you guys have any questions about adjustable versus fixed rate mortgages, you know how to reach me. And until then, I will see you in the next video. Don't forget to like and follow for more.